Hello, I am Private Asset Management Chief Investment Officer David Allen. Welcome to our second quarter 2022 Economic Outlook. Please note, before we begin our discussion today, that all information that we'll be presenting is as of July 12, 2022. For a more up-to-date look at the firm's outlook for economics and financial markets, please visit our company blog at pamgmt.com/blog. Before we turn our attention to our outlook for the U.S. economy over the second half of 2022, first, let's consider where we are today in the economy. A recent survey of consumers found that 55% of respondents believed that the U.S. economy was already in a recession. Though in the U.S., the official dating of any and all recessions is done by the National Bureau of Economic Research, the common belief is that 2 consecutive quarters of negative GDP growth is an indication of a recession. After the 1.6% decline in economic output in the first quarter and the continued tightening of financial conditions by the Federal Reserve, these recessionary fears are not unwarranted. However, we do not believe the U.S. economy is currently in a recession. Though the economy did contract in the first quarter, the data shows that this was due to negative contributions from a few relatively small areas of economic output. If we instead focus on the main parts of the economy, namely personal consumption and business investment, we see that growth in this subset of economic output actually accelerated to 3% from 2.6% in the fourth quarter of 2021. Moreover, recent ISM surveys of business activity show that while growth is slowing, it does remain above the 50 level, which separates expansion from contraction. At the current point, the ISM composite PMI suggests that annualized growth in the economy is 1.5%. This is just below the estimated potential growth rate of the economy. Finally, if the U.S. is in a recession currently, it's a very strange recession, in that the U.S. labor market remains very strong. As we'll discuss more later, the unemployment rate in the economy is very low and has not risen significantly in recent months, as is common leading into or in the early stages of an economic recession. Though we do not believe a recession is currently underway in the U.S., the risks of a recession in the future are certainly rising. A recent survey of economists found that the odds of a U.S. recession in the next 12 months have increased to more than 1 in 3. This increasing risk of a recession is due largely to the tightening of financial conditions that we've seen in the first half of 2022, as the Federal Reserve has increased interest rates. Currently, financial conditions are about 2/3 of a standard deviation tighter than they have been on average. As this chart shows, financial conditions are indeed tighter than they were earlier in the pandemic recovery. However, the chart also shows that conditions are not currently tighter than has been common over the last 30 years. This perspective informs our base case outlook for the U.S. economy over the second half of 2022 and into 2023. We expect the trend growth rate in the U.S. economy to slow over the next 2 quarters and enter 2023 at below estimated potential growth of the economy, as the Federal Reserve continues to increase interest rates in its fight against inflation. However, we do expect growth will remain positive in the second half of 2022, and that the U.S. will avoid entering a recession this year. Our outlook for the overall economy is driven largely by our outlook for the U.S. consumer. We expect growth in U.S. consumer spending to slow in the second quarter when that data is reported later this month. We anticipate that slower growth to continue into the second half of this year. Consumers continue to face historically high levels of inflation, which is generating extremely low levels of consumer sentiment. This extremely pessimistic consumer outlook, along with high levels of inflation, have combined to slow the pace of real consumer spending growth in the second quarter. This is despite household balance sheets remaining very strong. Following successive rounds of pandemic-related economic stimulus, U.S. households had accumulated an estimated $2.7 trillion in excess savings by the end of 2021. Though this balance of excess savings has been spent down in the first half of 2022, it's by a fairly small amount, just $114 billion. This leaves considerable savings still available to U.S. households to continue to spend despite the high levels of inflation they're currently facing. We expect households will continue to use excess savings to fund current period consumption. However, stronger consumer spending growth, particularly on discretionary items, will likely require an improving consumer outlook. Let's turn our attention now to business investment, where we also expect to see slowing growth in the second half of this year. Strong growth in business fixed investment has been a highlight of the economic recovery thus far. Early in the pandemic, businesses made large investments to accommodate a more remote workforce. Later in the recovery, as a supply-demand imbalance in the labor market emerged, businesses made investments in equipment to increase the productive capacity of their available labor. However, in recent months, we've seen growth in this sort of spending slow as interest rates have increased. Over the balance of 2022, we expect increasingly tighter financial conditions will continue to weigh on investments in equipment and intellectual property products. We also expect private inventories to be a net drag on economic growth in the second half of the year, following 2 consecutive quarters of historically large inventory accumulations. This relatively small category of economic growth may have an outsized impact on headline GDP growth over the next 2 quarters. This is one reason why we would encourage you to pay as much attention to subsets of overall economic growth as you do to headline GDP growth over the second half of the year. Though we expect private inventories will make a net negative contribution to overall economic growth in the second half of the year, that may be offset somewhat by a positive contribution from international trade. We have seen the nominal trade deficit fall from $107.7 billion in March to just $85.5 billion in June. Higher prices for oil and natural gas have increased the value of nominal energy exports from the U.S. Meanwhile, slowing inventory accumulation by U.S. businesses has slowed the pace of goods imports growth. Though the inflation-adjusted improvement that will be reflected in the GDP report is not as great as what we see here in the nominal trade balance, nevertheless, we should see a positive contribution from international trade in the second quarter and perhaps continuing into the second half of the year. Now let's turn our attention to the dominant economic topic of the last 12 months, inflation. Despite the interest rate increases that we've seen from the Federal Reserve, inflation remains historically high. In fact, headline inflation has accelerated as the war in Ukraine has led to higher energy and agricultural commodity prices globally. Though we've seen annual growth in core measures of inflation, which exclude food and energy prices, fall by about 50 basis points, we've also seen a worrisome broadening of inflationary pressures in the economy, as shown here in the 16% trimmed mean CPI. This measure excludes from its calculations the 8% of CPI categories which are growing the slowest and the 8% which are growing the fastest. In this way, we are looking at just the bulk of CPI categories in the middle of the distribution. The acceleration that we've seen that's continued over the first half of this year suggests that inflationary forces are broadening in the economy. This will keep the Federal Reserve focused on fighting inflation in the second half of this year. By increasing interest rates, the Federal Reserve is acting to slow aggregate demand in the economy. However, the Fed's own research shows that much of the inflationary pressures currently being felt in the economy are driven by supply factors. Recent research from the San Francisco Fed found that supply factors accounted for about half of the current spread between current annual PCE growth and the pre-pandemic trend. We are beginning to see signs that supply chains are improving. Supplier delivery indexes in both the ISM Manufacturing and ISM Services indexes have both seen improvements in recent months. If this trend continues, inflation may fall faster than currently anticipated, and the Federal Reserve may be able to slow its pace of monetary policy tightening. As the Federal Reserve makes its decisions about the appropriate path of monetary policy in the second half of this year, we expect policymakers to keep a close eye on the labor market. The labor market remains strong. In the most recent employment situation report for June, non-farm payrolls increased by 372,000, taking the 3-month moving average of payroll gains to 375,000. Also, the unemployment rate remains very low at 3.6%, and annual growth in average hourly earnings remains robust at 5.1%. However, other labor market reports show modest signs of weakening. For instance, the most recent job openings and labor turnover survey found that job openings fell to 11.3 million from 11.7 million in April. We believe this is a sign that the labor market is moving into better supply-demand balance, which should have a disinflationary impact on the economy more broadly. We also do not believe that the decline in job openings is a sign of weaker economic outlooks among employers, as there are still 1.9 job openings for every unemployed person in the U.S. We expect the Federal Reserve will increase interest rates by 75 basis points once again at its next meeting in late July, before ultimately taking policy into restrictive territory in the second half of this year. How quickly and how far policy ultimately moves into restrictive territory will largely be dependent on the incoming inflation and labor market data, as we take the Fed at its word that it will be data dependent in its future policy decisions. For instance, If economic growth remains strong and inflation remains high, the Federal Reserve may increase its pace of monetary policy tightening faster than current expectations. However, if both economic growth and inflation slow, we could see a slower pace of monetary policy tightening than the current market expectation. Those would both be relatively easy decisions for the Fed. The difficult decisions begin when economic growth slows and inflation remains high. Under this scenario, we expect the Fed would remain committed to fighting inflation as long as the slowdown in economic growth and the weakening of the labor market was mild. However, if economic growth slows more severely, or we see significant weakening of the labor market, we do expect that the Federal Reserve would slow its pace of monetary policy tightening to avoid any lasting damage to the economy. Thank you for joining us for this brief summary of our economic outlook for the second half of this year. I will now turn you over to our senior research analyst, Alex Dietz, who will share the firm's outlook for U.S. financial markets.
Thanks, David. The second quarter presented several headwinds to equity markets, ranging from a multi-decade high in inflation, aggressive monetary policy by the Federal Reserve, and the effects of the Russia-Ukraine war. Furthermore, there have been growing signs that the economy is slowing and the risk of a recession is on the rise, which helped push several indices into bear market territory. For the second quarter, the S&P 500 index fell 16.11%. The Dow Jones index fell 10.78%, and the Nasdaq index was 22.27% lower. The Russell 2000 index also performed poorly, producing a negative return of 17.21%. Rising interest rates had a disproportionate impact on growth stocks, reflecting weakness in the Nasdaq and small cap stocks in the Russell 2000. International markets posted poor returns as well, with the MSCI International Developed Market Index down 14.32% in the quarter, and the MSCI Emerging Market Index down 11.4%. In developed markets, the Eurozone has performed poorly as their exposure to Russia energy imports is driving inflation and shifting trade balances. In developing markets, China has been a weak performer given the continued regulatory crackdown on technology companies, property development issues, and COVID-0 policy. We note that short and sharp rallies within a downward trend are typical of bear markets, so investors should be prepared for more volatility. In fact, the largest daily and weekly up moves in markets tend to happen in what we call bear market rallies. While valuations have corrected sharply, we think the risk is that weakening earnings and profit margin outlooks could set up another leg down for the market. In the S&P 500, returns were negative across all sectors, although consumer staples, utilities, energy, and healthcare all held up the best. Consumer staples, utilities, and healthcare are typically viewed as defensive sectors, so their relative outperformance is not surprising given rising rates and fears of a recession. The energy sector was up as much as 20.81% by June 7th, but then subsequently fell 21.6% for the last 23 days of June. This marked a sharp reversal in the sector as market participants began pricing in aggressive Fed policy and recession risks. On the other end of the spectrum, the information technology, communication services, and consumer discretionary sectors produced the weakest returns. With the S&P 500 down as much as 24% in 2022, the S&P 500 has traded as low as 15 times analyst forecasts for next year earnings, currently at $246 per share. This is down from 26 and 22 times forward estimates from the high in 2021 and the beginning of 2022, respectively. The decline in valuations for growth areas of the market, represented by the Nasdaq and Russell 2000, has been even more significant than the S&P 500. While valuations look much more attractive than they did at the beginning of the year, we note that international markets, as measured by the MXEA and the MXEF, looked very attractive last quarter, but have only gotten cheaper as we move through the year. So while valuations do not look as rich as they did before the steep sell-off, investors should be reminded that timing the market based on valuations is typically not the best strategy. Instead, we think the best opportunity to capitalize on attractive valuations will come after earning estimates have been revised lower. Currently, the S&P 500 boasts an operating margin at a historically high level, but analyst estimates have largely stalled, indicating that an improvement will be difficult, or worse, a potential peak in profitability. We see a number of near-term headwinds on the horizon that could result in margins contracting as opposed to widening. First, the producer price index, or company input inflation, has been rising faster than the CPI index. Given historically low consumer sentiment, this means companies might be unable to pass along all of their higher input costs. On top of the rising cost of goods, comments on earnings calls from executives at large retailers suggest that demand for goods could be slowing. This has been evident in their weaker margins and rising inventories. Additionally, though we see the labor market supply and demand moving into better balance, the labor market is still very tight, which could further pressure profitability through higher labor costs. Finally, the evident slowing in the economy could mean that earnings estimates are a bit too optimistic. As we mentioned in our last update, there are signs that the cyclical portions of the economy have been slowing. For example, transportation companies like trucking and railroads have seen a significant slowdown in volumes of cargoes. Additionally, chemical manufacturers have witnessed an easing of orders for a range of their products, which is typically viewed as a red flag for weakening demand given their early position in supply chains. Home builders, building products, and household durable companies have also been poor performers, as rising mortgage rates crimp new home sales and all the products that typically benefit from household formations. More worrisome is the rapid decline in commodity prices we have seen as of late. Many base metals struggled immensely during the second quarter. Copper, which is viewed as a barometer for strength in the global economy, quickly fell 22% and has continued to slide into the third quarter. Oil, the world's most important commodity, has also fallen from its highs at a rapid pace. While many analysts are still bullish on these commodities, the large sell-offs have highlighted the skepticism around economic growth estimates. A signal that looks troubling for operating margins is the decline into contractionary territory for the new orders category of the ISM manufacturing survey. In the chart below, we plotted S&P 500 operating margins with ISM new orders with the 6-month lead. And as you can see, a decline in new orders typically leads to a decline in operating margins. However, it should be noted that the ISM services survey looks much better as consumers have been holding up on this spending post-COVID, though it remains to be seen how well the service economy will hold up, as analysts expect spending to weaken after the summer holiday season. While chatter of an economic recession has gotten louder through the second quarter, earning estimates have held up better than we would have expected. The chart shows the max drawdown in the S&P 500 as well as the 12-month forward earnings estimate. As you can see, there is a large discrepancy between the two, with the S&P 500 down 22% and earning estimates remaining elevated. We should also note it is evident that a large decline in equity prices does not always portend an upcoming economic/earnings recession, as other variables can also impact equities. While commentators have speculated that the market is pricing in a recession, we think the market has likely adjusted down more so on a rising discount factor and previously elevated valuations. Still, the discrepancy in the drawdown between equity prices and earnings is notable and merits attention. If you plot the spread between the S&P drawdown and that of earnings expectations, you'll find that gaps of this magnitude have only occurred during or immediately after recessions over the past 3 decades. At the risk of sounding repetitive, we see the biggest risk to equities coming from earnings estimates that we think will need to be revised lower. On a positive note, the sell-off could likely be complete once earnings estimates have been marked down. While financial media have often pointed out strong earnings estimates from Wall Street analysts as proof that the corporate profit outlook remains strong, these analysts have a relatively poor track record in predicting earnings recessions. The chart shows rolling 1-year forward EPS expectations for the S&P 500 overlaid with actual earnings over the following 12 months. It is not surprising to see the large gaps emerge here when the economy begins to slow significantly. We note that in the post-COVID era, realized earnings have actually exceeded sell-side analysts' collective forecasts, which has been a unique phenomenon when looking over the last 3 decades. Perhaps this has in part informed the confidence in the expectations for corporate profits, though the magnitude of EPS positive surprises has been declining significantly since the onset of COVID. We think earnings will ultimately be held hostage to the fate of the economy, which most would say is facing virtually unprecedented headwinds across a range of factors and geographies. If the economy remains strong, then earnings could hold up better than we expect. However, this could mean that inflation proves resilient and the Fed may have to tighten even more. If the economy weakens, then earnings estimates will likely fall and the Fed might not have to be as aggressive with its policies. As such, the earnings debate seems to be the most important topic among equity market participants for the upcoming quarters and will likely determine performance throughout the rest of the year. As we expected, fixed income returns continue to be challenged after a historically bad first quarter, as elevated inflation and rapid tightening by the Federal Reserve put upward pressure on yields across the maturity spectrum. The Bloomberg Aggregate Index was down nearly 4.69%, following a 5.93% drawdown in the first quarter. For corporate bonds, both investment grade and high yield bonds performed poorly. Rising interest rates and higher duration weighed heavily on investment grade bonds, while widening credit spreads offset the higher coupon payments in the high yield bond market. Treasury inflation protected securities fell 6.08% in the second quarter and underperformed nominal Treasury bonds, which fell 3.78% as a declining tip spread magnified the rise in interest rates. A large portion of the change in yields occurred at the short end of the curve as the Fed has quickly increased the Fed fund rate in response to persistent inflation. The yield curve essentially made a round trip based on the spread between the yields of the 2-year and 10-year treasuries. After inverting at the beginning of the second quarter, the 10-year reached a high of 3.47%, and the 2-year reached a high of 3.43% in early June before declining back to roughly 3%. With headline inflation still high, it may be hard for bond yields to fall much further in the near term. However, it also appears that the roughly 3.5% level reached in June could mark the high for the year, as the market appears to be shifting its attention toward a potential recession over inflation fears. If recent economic trends continue, it would not be surprising to see the 10-year Treasury yields fall further in the second half of the year, perhaps as low as 2.75%. That may prompt the Fed to slow its pace of rate hikes and/or alter its tightening plan later in the year, especially if inflation begins to cool and the labor market loosens. While it may seem counterintuitive, the more the Fed front-loads its rate hikes and runs the risks of triggering a recession, the lower long-term bond yields can fall. Last quarter, when the 2-year, 10-year yield spread inverted, the Fed countered the alarm bells ringed by investors by noting that their preferred recession warning indicator was the 3-month and 10-year spread. While it is still positive, the spread contracted from 2.31% to 0.99% rather quickly and should continue to narrow as we expect the Fed to raise interest rates by 75 basis points and 50 basis points over the next 2 meetings. To be sure, the spread between the 3-month and 10-year Treasury has always turned negative before each of the last 4 recessions. It is possible that quantitative tightening could support longer-term yields and prevent an inversion. However, we think if the market is worried about a recession, then demand for Treasuries should put downward pressure on the 10-year yield. As we noted, both investment-grade and high-yield corporate credits performed poorly in the second quarter. Economic growth is expected to slow this year compared to last, as indicated by the first quarter GDP report, which could weigh on corporate profits. Meanwhile, the Federal Reserve is planning an aggressive pace of rate hikes, which should result in tighter financial conditions and higher borrowing costs. Given those myriad risks, we think investors should be cautious with high-yield bonds. Given that yields on higher quality investments are up so much this year, we prefer investors to move up in quality and wait for better opportunities to take on more risk down the road. Currently, the average spread of the Bloomberg U.S. Corporate High Yield Bond Index is up sharply from 2021 lows. However, given the risks we see on the horizon, we think there's room for this spread to widen further. Additionally, when the Fed tightens, the high-yield market usually begins to show cracks, especially when the yield curve is flat or inverted. There are various yield curves to look at, but the 2 most cited curves are the 2-year 10-year and the 3-month 10-year. Today, both curves are moving in the same direction. However, only the 2-year and 10-year curve is inverted while the 3-month 10-year curve is under 100 basis points. Over time, high-yield bond total returns relative to treasuries have been strongest when the yield curve is steep, which makes sense given that the yield curve is steep typically when the economic growth outlook is strong. The tables shown here compare the average 12-month total return of the Bloomberg High Yield Index relative to the Bloomberg Intermediate Treasury Index, depending on the starting slope of the 2 yield curves. The analysis tells us that when the slope of the yield curve is flat as it is today, caution is warranted in the high-yield bond market. While we are not recommending a complete abandonment of high-yield holdings, we suggest trimming positions to reflect heightened risks. High yield bonds were very attractive over the last couple of years, as most other bonds were stuck near historic lows. But today, there are ways to earn higher yields without taking on so much risk. The yields on higher rated bonds are close to the highs we've seen in the last 10 years. Given the market headwinds we are witnessing, we think investors should move up in credit quality, but also think taking on some more duration is acceptable. The investors who purchased TIPS were probably not too happy to see these bonds underperform treasuries during a period when inflation was rising month after month. It is important to remind investors that these bonds reflect inflation expectations, and therefore, much of the inflation was already priced in. We noted in our last update that the TIPS spread looked a bit wide and that the cost of protection using TIPS against inflation was rather high. TIPS are now pricing in a 2.33% average rate of inflation over the next 10 years and only 2.04% when looking at the 5-year period 5 years from now. While TIPS are beginning to look more attractive from a price perspective, we think upcoming economic risks could lead to further underperformance relative to treasuries. Compared to other fixed income investments, extending duration in the muni market looks attractive. One metric we track is the yield relative to duration. All things being equal, the more yield per unit of duration, the more attractive the fixed income security is. Muni yields relative to duration stack up well against other fixed income investments. For example, the yield to worst on the Bloomberg Municipal Bond Index is roughly 3.3%, but after adjusting for taxes, the tax equivalent yield can be as high as 5.6% for an investor in the top federal tax bracket. However, the duration of the index is slightly longer than 6 years. In other words, investors are getting better compensated for taking interest rate risk in the muni market relative to most other markets. The chart shown here differs from the tax equivalent yield chart because it does not include a state tax rate. The tax equivalent yield in the chart shown here would be near 6% if a state tax rate were included. All right, that wraps up our economic and financial market update. If you have any questions, please do not hesitate to reach out to your portfolio manager. For a more in-depth view of our outlook, feel free to find the document on our website. Once again, I'm Alex Dietz. On behalf of Private Asset Management, we'd like to thank you for watching, and we'll see you next quarter.